Ryan will be replacing Merle Good, who could not make it. Ryan works here in Lethbridge with KPMG. He's a chartered accountant and tax specialist who works predominantly in agriculture. So please help me welcome Ryan Stevenson.
All right, thanks, Autumn. I kind of filling in here for Merle at the last minute, and anyone that knows Merle knows he's not exactly a replaceable individual, but I'll do my best to kind of convey his thoughts. All right, so first we'll just kind of do a kind of an overview of kind of a farm snapshot for all of Canada. In 2011, Canada had approximately 9,600 farms that reported over $1 million in gross farm receipts, which is a 31% increase from 2006. And of these farms, they accounted for 4.7% of them accounted for about 50% of all the receipts, which is up 3.2% and 42.8% respectively from 5 years earlier. So basically what that means is that a smaller number of producers are now producing a greater number of the quantity of agricultural products. We're also seeing kind of a shift towards oilseeds and grain farms as opposed to beef farms. So a large portion of that probably is the input cost that we're seeing with regards to agricultural commodities, but we're definitely seeing a decrease in the number of farmers that are interested in having cattle as part of their operation. If we take a quick look at cattle inventory over a number of years, about 30 years here, we can see that we're actually seeing a decline in numbers significantly over the 30-year period here, and this is U.S. data. But for the most part, U.S. and Canada would be in similar industries. We're looking at cattle prices now. We're seeing about $1,000 for a calf when we're making a sale, as opposed to, if we're doing a bred cow, we're getting about $1,300 right now. So we're only seeing about a 30% premium. Now, if we look back in, say, 1995, 96, in the better years in the cattle industry, we're actually seeing a 75 to 100% premium from going from a calf to a bred cow. So we're seeing a real decrease in the margins. So it's making it a lot harder for individuals in the cattle sector to make a living. The next slide kind of looks at U.S. corn yields, and the biggest thing that we kind of want to show here is last year we had the drought. In 2012, you can see that bushels per acre were down significantly in the U.S., and that kind of impacted our prices here in Canada, and we saw really high prices for our commodities last year. That also had the impact on our cattle industry with really high inputs. We had a tougher time making our margins and making profits in the cattle industry. Next, Merle kind of wants to go over personal tax rates. So obviously, depending on how you've set up and structured your business, you can either be an individual, so a sole proprietor, and pay tax at the marginal rates based on what your income is. And these will be the rates for 2013. So as you can see, the more money you're making, the more you're giving away to the government. The next slide kind of talks a little bit about what the corporate income tax rate is. So if you've structured yourself into a corporation for 2012 and beyond, if you're under the small business limit of $500,000 of net income, you're going to be paying tax at 14%. Anything above that $500,000 mark, you pay tax at 25%. Next, we kind of just want to talk a little bit about strategies to reduce the taxman's bite, as Merle calls it. And basically, kind of what he's talking about here is oftentimes around year end, what farmers will do is they'll come into their accountant, their advisor, and look at where they're at from an income position and say, okay, here I am, I'm at $200,000 of income, but really I only want to pay tax on $100,000. So what farmers can do is they can go out and spend $100,000 because you report on a cash basis, so cash in, cash out for the year. And basically, as long as those expenditures at year end are reasonable in relation to the size of the business, and you have the goods on hand at year end, or the supplier had the capacity to actually get those to you, and the expenses for a specific good, and that the goods are used by the end of the next tax year, it counts as a deduction for you. And then just a tip on that is if you are using a credit card to make that purchase, you actually don't have to pay it before year end. You can use the credit card as the expense without actually paying it. So you can kind of take the expense in the current year and defer it into the next year. We also wanted to go over an example of a strategy of lease versus buying assets. So basically in this example, the way it's working is we're saying we're going to have a $100,000 tractor that we're going to purchase. So if we purchase a $100,000 tractor, we're basically going to get in the first year of purchase a 15% deduction of the $100,000 for tax. So we have, if we're trading in an old tractor for $40,000, we get a $9,000 deduction on our tax return. However, if we were to say lease that tractor, the first lease payment would be roughly $18,000, and we keep the old tractor, we get a deduction for that one at 30%, because in the first year you own a tractor, the reduction that you get for tax is reduced by half. So in theory, if we lease that in the first year without a trade-in, we're actually getting about a $30,000 deduction as opposed to a $9,000 deduction. In 2014, you would trade in the old tractor against the lease payments, and then at a future date, when you purchase the lease out, you're purchasing at a smaller amount. So basically, what we've done is we've taken a principal payment on our debt for owning a tractor and turning it into a full deduction by owning a lease payment. So again, if we take that same example, but we double the first year lease payment, we make a $35,000 lease payment, and then we take the trade-in of CCA of $12,000, and now we bought a $100,000 tractor with a $50,000 deduction. So basically, you can see that if you kind of play some games with the way you set up your leases versus purchasing assets, you can increase your deductions. It is a kind of an aggressive strategy. You need to consider if you want to take that route, but it's definitely a possibility in planning. The other thing you kind of want to consider is that when you are doing this, if it is coming up to a year when you're possibly thinking about incorporating your farm. So currently you have a proprietorship owned personally, you pay all your tax on your personal tax return, you're paying at a high rate. So if you're paying at the top personal rate at 39% in Alberta, and you get that $50,000 deduction, and then you buy the tractor out once you're incorporated on the lease, at that stage, now you're buying it out a small amount, and if you say make money on the sale of that, you're taxed in the company at 14%. So you've basically taken a deduction at a 39% rate of tax, and you're actually paying on the income on the resale of that at a 14%. Next, we want to talk a little bit about oil and gas payments, especially we're starting to see a little bit more of that coming into Southern Alberta. So there's all sorts of different types of payments that you can receive from, say, a Cenovus or an Encana or whomever wants to come onto your farmland. So basically, I've kind of compared a little bit of a list here, and what the list does is it kind of indicates what are capital versus income treatments. So capital would be your entry fees, any damages that are non-crop related damages, anything that's damaged to your land value, a right-of-way or right-of-entry payment. Whereas income items would be signing fees for signing the contract, crop or fence damages, general disturbance like if they're making noise on your property, inconvenience or nuisances, rent and temporary workspaces. So basically, what the idea is kind of if you're kind of planning and making the arrangements with the company, if you set up the contract right, you can kind of set it up so that you gear things more towards a capital tax treatment. And basically, when it's capital, you only pay tax on half of what you're receiving. So you basically effectively reduce your tax 50% by structuring the deal a little bit differently. So if you do have deals in place, et cetera, you can kind of go and talk to either your accountant or your tax preparer, and they should be able to help you with the tax treatment of what it is, but it's going to be tough for them to identify it without looking through the contract itself. The next thing I wanted to go over is restricted farm losses. So on a high level, basically what the restricted farm loss does is it says if you have income potentially from another type of business or another source, say you're employed somewhere else and that's your principal source of income, and then you have losses on your farm, they want to restrict your uses of those losses to write off against your other sources of income. Now, what happened in, I guess, last year, the result came out, is called the Craig case. So it was a case that went to the Supreme Court of Canada. And basically what it was there was a lawyer in Southern Ontario who was making a whole bunch of money at his law practice. And then he really liked horses, so he had a horse business on the side that he had to treat it as a farm. And basically he was taking his losses on his horse farm and writing it off against his legal practice. And basically CRA said, no, we don't like that, we're going to restrict your farm losses. And basically he took it all the way to the Supreme Court and he won. So he was able to write off all those losses. So we're thinking, oh, big win for the taxpayer. But then in the 2013 federal budget, they said, nope, we don't like that, and they've changed the rules to get more in line with what they actually want. However, what they have done is they've actually increased the amount of restricted loss you can claim. So previously you could only claim $8,750, whereas now you can claim $17,500. So there is a little bit of a benefit there, but they actually hadn't changed that number of what your restricted loss could be since the 80s, so it was probably about time. Next, we'll just talk a little bit about tips for forming a corporation, so going from that proprietorship where you pay all your tax on your personal tax return into a corporation. So the first thing with a corporation is there has to be ownership of that corporation. So that corporation is going to have a share structure. And now there's multiple different types of shares that you can own. So whether they are preferred and voting or non-voting or common and non-voting. Basically what that means is you need to kind of sit down and think about where we want to go with this farm. So if we're incorporating, say mom and dad are kind of stepping away from the operation, but they have built the farm up to what it is. We can issue them preferred non-voting shares that have a fixed value that'll act more like a debt. So basically if the farm was worth $2 million when the kids took over, we can issue $2 million of these preferred non-voting shares to the parents, and then they can get paid out over time on that money. Then the children can take over the common shares, and the common shares get all the future growth of that company. So any growth above what it's currently at would be attributable to the kids. So that's kind of one just example. Another example might be, say, you want your farming child involved in the company, but he has a spouse, and we're going to issue shares for her for tax planning reasons, so we can do some sprinkling of income out to other, the family to kind of reduce the overall tax bill. But what we can do is we don't really want them having any say in corporate decision making, so we could issue them a common non-voting share. So they're attributable to the growth of the company, and we can get income into their hands, but we don't have to actually let them vote on corporate decisions. Another big consideration is land. So do we want our land in or out of the corporation? And normally what we're going to say is no, we don't really want it in there because we have what's called the capital gains exemption, and farmland qualifies for that. And basically on a gain of $750,000 on the sale of farmland, you pay no tax. So if we put it into a corporation, we lose that tax benefit. But there are some other considerations that we can look at. If we have the land in the company pays tax at a much lower rate than what you do personally. So if we look at the next slide, it'll kind of go over that. So if we had a $3,000 payment and we had to make that personally, and we're in the top marginal rate, so we're making over $100,000, we are paying tax at 39%. So we actually have to make almost $5,000 pre-tax in order to pay off that $3,000 payment. Whereas if we have it in the company and we're paying tax at the small business rate at 14%, we actually only need to make about $3,500 to make that $3,000 payment. So from a cash flow perspective, if we're purchasing land, it can often be really beneficial to actually own it in your corporation. So it's just a consideration that it's much cheaper to own land in a corporation, where we do lose that tax benefit, but it definitely can be a consideration. Another kind of thought before incorporating is a partnership. So oftentimes we can have a husband that's had the land, he's farmed it for a long period of time, and now he's thinking about incorporating. Now, potentially the wife has been involved, but not at the partnership level. So what we can do is we can transfer assets into a partnership between the husband and wife. If now the farm is a partnership and the husband and the wife are now doing it together, we can do a 2-year period where they have to farm as a partnership, and then we can basically take a partnership interest and transfer it into a corporation and use that same capital gains exemption that we just talked about to basically have the corporation owe a big tax bill back to the individual mom and dad farming. So basically you've taken your farm, incorporated it, and had the corporation owe you a whole bunch of money. So now you pay tax at 14% in that corporation, and it owes you all that money because you've used your capital gains exemption to move your partnership interest into a corporation. So what that does basically is now you've, say, got $750,000 potentially times 2 for mom and dad of money that you can pay tax at 14% and then flow out to the individual shareholders at no tax. It can be a really good retirement strategy. Oftentimes what can happen is when we have old age security as a senior, if your income is over a certain amount, so $65,000, you actually get that payment clawed back. So you actually lose the receipt of that payment. But if you can actually flow your income through the corporation and then out to yourself tax-free, you don't actually lose any of that clawback. So it's definitely a consideration if you're considering retiring, depending on how you've got your business structured. Another consideration that we can talk about a little bit is surface lease payments. So oftentimes, mom and dad are ready to step away from the family farm, pass it on to child, but we have all of these surface lease arrangements with different oil and gas companies. And mom and dad want the income off of that. They don't need the land, they're not farming anymore, they're fine with the son or the daughter taking over all the income from the farm, but they want to keep these surface lease payments. So under the Property Law Act, we can actually do that. We can basically assign the lease to mom and dad and put the land in the name of son and daughter. And basically that just kind of protects the parents' interest and makes sure they receive it. And a lot of times that makes a lot of sense because son or daughter may not make the payment to mom and dad, whereas Synovus will definitely do that. So the other consideration is if you're going to go down this route is that you have to kind of either put a duration on the assignment. So at what point in time does the surface lease arrangement end so mom and dad don't get it anymore? Because if mom and dad has happened to pass away and their will doesn't specifically indicate who that surface lease is going to be passed on to, it falls into the residue of the estate and it could end up with somebody that they don't necessarily want it to. If son's got the land and they want the surface lease going to son, but son, daughter, both are entitled to the residue of the estate, now the daughter has half of that lease where the son has the land, and that might cause potential issues. So it's definitely a consideration that you need to think about before making that assignment of lease. The next item to talk about is qualifying for the capital gains deduction. So basically what Merle's trying to get at here is if it's anywhere in the family line from great-grandfather to great-grandchild and it's that farming land or qualified farm shares of a corporation, anything that qualifies, as long as it's in that family between great-grandfather and great-grandchild, you actually can qualify. So you just have to kind of meet the gross revenue test, which means that it has to have been actively farmed and in 24 months prior to the seller actually moving it away from the farm. The one thing that you also just need to kind of watch a little bit when you're doing this is if you are transferring land from one generation to the next, they actually have to hold it for a period of time before they can sell that land. So if you do it before that period of time is up, you actually don't get access to your capital gains exemption. So you need to be careful when you're planning it if you're going to do that to kind of maximize your capital gains exemption within the family on the sell-off of the farm, that you are actually doing the proper steps ahead of time, because you can't just transfer it to child, sell it the next day, and use up more capital gains exemption. It's definitely something that has to be planned ahead of time. So kind of on that route, talking a little bit about kind of the rollover, basically you can roll property down from generation to generation in farms without paying any tax, which is very unique relative to any other industry other than fishing in Canada. There's definitely special rules with farming. So basically as long as that farm stays within the family, it never actually has to pay tax as it's transferred from one generation to the next. So it's definitely a unique opportunity that we have from a tax planning perspective for farmers. So it's definitely just one of those things that you want to consider and think about and plan about, and farming kids versus non-farming kids and how we want to structure our affairs. So it's definitely something not to take lightly, because there's some definite tax benefits that we can take advantage of if we're doing proper planning. This next slide, I really have no idea what Merle was thinking. So I don't really know where to go with it. I was thinking that maybe he's talking about skipping a generation, because, if you look at the family and you're looking at the queen and you're looking at the screw up in the middle, and then the grandchild, maybe you want to skip a generation, which is definitely possible, but other than that, I have no clue what he was getting at there. The next thing that I want to talk about, which I actually understand again, is the estate freeze. So basically, if we're going to look at an example, so farming parents, their son, he's been working on the farm for 10 to 15 years, and paying him a wage. They're definitely comfortable now that he is going to be a career farmer, and they want to include him in the future growth of their farming corporation. And now they want to kind of step away a little bit, let him take everything over. So we want to say, okay, well, how do we do that? So basically we do what's called an estate freeze. So basically, if mom and dad have this farm company and say it's worth $1 million, dad owns 45% and mom owns 55%. So basically those shares are what were issued on the original incorporation of the company. And there's no other shares outstanding. So dad's 45, mom's 55, farming company is worth $1 million. The first step would be mom and dad take their common shares and then they exchange them for their proportionate ownership of preferred shares. So basically now dad takes 45 common shares and he takes back 450 Class A preferred, redeemable, and retractable shares. And then mom does the same thing. She takes her 55 Class A common shares and exchanges those for 550 preferred shares. And then you can redeem those shares at $1,000. So basically what they've done is they've taken the same value of common shares that they have and they've just exchanged them for preferred shares with the same value. The next step is now you can issue common shares to the son, because the whole value of the company was $1 million, and we've basically taken that $1 million and transferred it to mom and dad in those fixed value preferred shares. So they're worth $1 million each. So now new common shares can be issued out of the farming company for a nominal amount, so $1 a share, to the child. And the reason that we do it this way is because if you were to just issue common shares to the son, he would have to pay whatever their fair market value is. So because he would basically have to pay however many portion of shares that he would want, they were worth $1 million. So he had to pay a proportionate share of $1 million to do that. And for most people, I mean, with the way land values have gone up since the parents owned the farm, there's no way that that child is going to come up with that kind of money to buy in from that perspective. So it's kind of a way to get ownership transferred from mom and dad to son without any immediate tax consequences. Now, basically when those preferred shares that mom and dad redeem over time happen, they're going to pay personal tax on the redemption of those amounts. But you can spread that out over a period of time, so you can constantly be using your lower tax rates in order to do that. Now, as long as the farming company stays on side as a farming company, it doesn't build up too much cash or other types of assets in that farming company, those preferred shares on death can actually roll down to the child without any tax consequences to the parent on the estate. Another situation that we often encounter when we do this is that the parents aren't necessarily working as much as the child, and the child is doing the majority of the work but actually taking less money out of the company. So we have to kind of consider, well, is that fair? So their thoughts are, well, yes, mom and dad are entitled to, a decent retirement. And, well, yes, but only if the money is used strictly for personal living and they're not doing anything else with it that, the son isn't happy about, or no, since they only work 500 hours, why should they earn more than the son who's working a significant amount more? So often a good way to kind of look at it and think about it and talk to family farming corporations about it is, well, let's look at what is the actual payment about. So if we look at a breakdown of, okay, well, there's labor and there's management and then there's return on capital and redemption of the preferred shares. So if we look at the management of the farm, well, dad's doing $10,000 worth of work versus son's doing $5,000. And then if we look at labor, well, dad's doing $10,000 there, but son's doing $40,000. And then if we look at land, we say, okay, well, the company's using mostly dad's farmland that's been left outside of the company and a little bit of son's that he's purchased as he's getting into farming. And then if we look at capital redemption, well, dad has all that value frozen in preferred shares and son has none of that. So in reality, you can kind of look at it from that perspective and say, well, actually, it's quite reasonable that he's taking out $60,000 and you're only taking out $50,000. If you look at it from that perspective, it's often just sitting down and thinking about it and talking before anyone gets upset. The next slide is kind of going back to the freeze, but kind of showing you how you get to that value. So basically, in this situation, they're saying, okay, the family farm has assets that have a fair market value of $2 million. So what you're sitting there on your balance sheet at might not necessarily mean what they're actually worth if you sold it. So your book value can be different from your fair market value. So if you take the fair market value of your assets and they're $2 million, and you look at your debt that your corporation has, and it's sitting at 0.3, then you're basically saying, okay, this company has an equity value of about $1.7 million. So again, that's when the freeze would come in, and we would say, okay, we'll take back common shares to Sun at $1 a share in nominal amount, and the preferred shares are the parent at that fair market value of that company. And then we can structure an arrangement where mom and dad take X number of dollars out per year as a redemption over a period of time. The next one is, it gets a little more complicated as far as the tax planning side of things, and definitely have to have the assets in specific classes, but it's basically called a butterfly. And basically what mom and dad can do when they do a butterfly is they can kind of involve children at different amounts of properties, and they could take land and split it. It definitely has to be very specific situations that we can make it happen, but basically we could take the land out of the dairy farm with the equipment and the inventory and split it out into 2 land corporations and bring, say, daughter into one and son into the other, and kind of make it work. But it's definitely one of those situations where you have to have the right facts in order to do it, but it's definitely a possibility and can definitely avoid a significant amount of tax if we're trying to transfer land. The next thing is kind of, again, one of Merle's concepts, and since I didn't get a significant time to talk to him, it's kind of my interpretation of what Merle put on PowerPoint slides. So I think, basically what I think he's trying to get at now is that over the last few years, land values have gone up significantly, especially in our area. Now, I mean, lower financing rates and the high quality of returns on crops and the yields and the prices that we're getting definitely are having an impact on that. But it's just more of a matter of, is it really worth it to buy land, or should we be renting? So if we kind of go to the next slide here, it kind of looks at what kind of payments are you making on your land purchases versus what do you actually pay if you were to rent that land. So he has 3 years here of 1981, 1993, and 2012. Now in 1981, land values were, again, they were very inflated based on whatever market conditions were around. So you had to pay about $190 an acre to finance the purchase of land. But at that same period of time, to rent an acre of land was only $40 an acre. So basically you paid 4.75 times the amount in cash to own that land versus rent it. And then similar idea in 2012, the land values are higher. Cash rent is about $80 an acre, so we're at 3.0. Now, 1993, when the economy wasn't as good, we had the purchase price was a lot cheaper, and you only paid about 2 times what you paid in rent to own land. So the idea is that does your cash outflow to purchase outweigh what the actual benefit is of the production you can make off that land? So in this one, basically what he's trying to get at here is that when you compare when you purchase land, what your return off of that land is to what you would actually get if you were to be investing on the TSX, you'd basically be at about a similar rate at the purchase price of, say, $3,000 an acre, which is about what market value would be right now. This slide kind of just looks at land rent value factors. So basically what that does is, if we look at my original example where I said, okay, in 2012 it was $3,000 an acre to purchase land, but it's $80 an acre to actually to rent that land, we're basically at a 37.5 times cash rent costs to own that land. And that's basically consistent with this chart that he's found with land in Iowa. But basically that means that if we start to get to a level we're paying like 45 to 60 times what we would pay in rent to own land, then it's not particularly worth it. So if it's costing you, $80 an acre to rent land, but it's going to cost you over $3,600 an acre to purchase it, well, it's time to start thinking, is that land overvalued versus what the return I'm going to actually get on it? So it's just more of a thought, like, let's be thinking about, does it make sense to actually be buying this land at the current market rates? Not to say that it doesn't. There's lots of other benefits of owning the land, but it's something to be more aware of, as opposed to owning is always better. A couple rules that he's kind of got here is he's saying that the price to earnings ratio, if you're between 20 to 22, so you buy it for this much and you can earn that much off of it, as long as you're 20 to 22 times that. So earnings of $1,000, if you were $100 and you were to have $20,000, you're kind of roughly in that range for purchase price. And then again, the cash rent multiple that I just talked about. Another kind of useful tool, especially if you're kind of incorporated, is just to kind of look at what he's calling a farm health check. So basically what that is kind of just looking at, your balance sheet and your income statement when you go and you meet with your accountant or your tax, preparer, and saying, okay, let's look at my current situation. So if I have an operating loan and some payables and some cash advances, and then I have, unsold inventory and some prepaid inputs and some amounts receivable to me, if I were to collect all the amounts that sell my inventory, use my inputs, and collect all my receivables, would I be able to actually pay off my operating loan, my accounts payable, and my cash advances? So it's kind of looking at your current situation, and if your current obligations came due right now, could you pay them off? Another thing to look at is just your operating expenses. So there might be expenses in your operation that don't necessarily relate directly to operations. So we take those ones out and we look at, are those operating expenses less than 65% of what I'm actually bringing in? And then the other one is just your machinery investment being less than 1.5 times what your gross revenue per acre is. And then also watching that you don't have debt more than 40% of the book value of your assets. So if your assets are sitting there at $1 million, you don't want more than $400,000 in debt. And just kind of an overall just kind of check and make sure that you're doing things properly. So basically he's kind of got this thing where we're talking about kind of balance. So basically just always making sure that we're looking back and we're making sure that everything on our farm makes sense and that's in check and balanced out. So that's kind of all that Merle had for you. So I don't know if there's any specific questions on anything that I talked about, but yeah, Lee?
So Ryan, with that capital gains exemption, like that's changed recently, right? It used to be $500,000.
It used to be $750,000 in the 2013 federal budget. They've actually bumped it up to $800,000, and then they said that going forward they're going to index it to inflation. So basically, from $800,000 every year, it'll increase, say, 1 to 2%. The rules on it are a little bit different. So if you've already sold land and you've kind of set up a reserve with your accountant where you're bringing it in over a period of time because you're receiving payments in over a period of time, you don't get access to that extra amount going forward. So there's a little bit of planning that you kind of have to do. But if, say, you did sell the land in 2014 and you sold it for $1 million, $800,000 of that would be tax-free, and then going forward it would be indexed towards inflation.
So, but is it like $800,000 above what you paid for it, or is it just flat?
Yeah, above what you paid for it. So the gain. So if you paid $100,000 and you sold it for $900,000, $800,000 gain, no tax. Assuming that it's owned personally and not in a corporation. Yeah.
How does the crop share basis fall into place with that being able to be allowed for that capital gains exemption?
With having a crop share arrangement on your personally owned farmland. So basically they look at what is called principally used. So if, say, you've owned this land and you've actively farmed it for 35 years and you've taken crop share on it for 5, then you would still qualify to use that exemption. But basically that principal use test comes into play, and there's some other kind of complicating rules. If you owned the land prior to like 1986 and it was actively farmed, you kind of automatically can kind of get into it. But there's definitely some considerations there. So if you have been using a crop share or a cash rent arrangement for a period of time, it can disqualify you from that exemption. But in likelihood, if you've owned it and actively farmed it, you would still qualify. Okay, thank you very much.